Folks, just 6 weeks ago, the stock market was in free fall. President Trump's liquidation day in early April sent stocks into a tailspin. Panic was everywhere. But while most experts were calling for doom and gloom, one strategist, one of the greatest of all time, stood his ground. Fundstrat's Tom Lee didn't flinch. He told investors to stay the course, insisting the long-term trend would be incredibly bullish. He even went so far as to predict new market highs this year. At the time, it sounded contrarian, maybe even crazy. Yet here we are, witnessing one of the fastest market recoveries in history. Stocks have nearly erased all of their losses, the S&P 500 is charging back toward record levels, and the market is green on the year. So how did Tom Lee see this coming? And what does he think happens next? We're breaking it all down for you. To make this video, we dug through countless Tom Lee interviews, media appearances, and his firm's press releases. If you appreciate the research, do us a favor. Hit that like button and subscribe. It helps YouTube share this video with more people like you. And remember, if you're taking the ultimate risk, you've got to do the ultimate frisk. A lot of folks get risky, but not everyone does their homework. Let's get started. So, Tom Lee originally predicted that markets would bottom on April 2nd, what he called Liberation Day, when President Trump first announced those tariffs. But the tariffs ended up being way harsher than anyone expected, and well, the market didn't bottom right away. Once those extreme tariffs were paused and negotiations started up, we saw this massive bounce in equities. Tom Lee was off by about a week. And honestly, if you checked out the comment sections on my videos, or even on Tom Lee's own videos, everyone was calling him an idiot. But here's the thing, that overwhelming negativity was actually a huge buy signal. When everyone's angry at Tom Lee, that's when you know it's time to buy hard and buy heavy. During that extra week of market pain, Tom Lee just kept telling people to calm down and, focus on the bigger picture. He didn't expect those tariffs to last, and he predicted a rapid de-escalation. And well, that's exactly what happened. This is classic Tom Lee. He might not nail the exact date or headline, but he consistently gets the big picture right. I mean, you can't predict every twist and turn, but you can definitely spot the overall trend. Throughout his career, Tom Lee has believed in buying companies with fast, consistent growth, lots of value add, and strong competitive edges. That's why, honestly, he's always long-term bullish. He believes good companies always find new ways to innovate, make money, and deliver value for shareholders. Sure, he might miss the timing on individual downtrends, but as long as history repeats and companies keep improving, he's betting on the long game. When everyone's screaming Lee is an idiot, that's usually the biggest buy signal there is. Nearly every Wall Street expert said this downturn would last for years and that we'd never see all-time highs again. Even I was pretty agnostic. I said if Trump kept the tariffs, it'd be bad, but if things de-escalated, it'd be really good. Tom Lee, though, was confident the tariffs would be walked back. He said, "Don't panic, this downtrend will reverse." And well, he was right. So what made Tom Lee's contrarian call so accurate? He pointed to 3 big factors. Credit markets stayed calm. The high-yield bond market, often the canary in the coal mine, never confirmed the panic. Market history favored the bulls. After a rapid waterfall decline, stocks usually bounce back just as sharply. In fact, 17 of the last 18 similar declines since 1950 saw a V-shaped recovery. The only exception was 2022's inflation-fueled slump, and even that recovered a year later. Corporate resilience. Earnings trump Armageddon. Despite all the chaos, companies delivered solid results. First quarter earnings and forward guidance came in far better than expected. The fundamentals held up, and businesses proved they could manage costs and thrive despite the headwinds. Lee's message is clear. When you're looking at the market, you need to follow a few key rules. Always stay in to win. Don't miss the best days. During the April plunge, many investors bailed out in a panic. Some even rage sold at the bottom. Now, after a more than 20% rally, those same investors are, chasing back in at higher prices, having missed the bulk of the gains. Lee points out that if you miss just the top 10 strongest up days in a year, the S&P 500's annual return drops to a measly 3%. Those few big days really make the year, and you only capture them if you stay in the game. So, is it too late to join the party? Not at all, says Tom Lee. He argues there's still plenty of fuel left for this rally. Despite recent gains, the market is still roughly flat on the year. Most investors are still on the sidelines, honestly, scared to get back in. If you look at the world's 25 largest public companies by market cap, revenue, and impact, only 4 are non-US based. That means a lot of global growth and profits are still concentrated in American companies. Eventually, that money will flow back into US markets. Lee says there are still bargains out there. Many high-quality businesses were crushed in the spring sell-off. Now, those washed-out stocks are ripe opportunities for investors with courage and a long-term view. And there's a mountain of cash, about $7 trillion, sitting on the sidelines in U.S. money market funds and savings. As trade war fears and recession chatter fade, that cash is potential buying power just waiting to come back in. You know, Lee's point is that you don't have to be right about everything. The market just has to be, well, less wrong than the consensus. If things turn out even a little better than expected, all that sidelined cash could honestly flood back in, driving stocks higher. This is the classic contrarian setup. Negative sentiment plus huge cash reserves equals a potential buying frenzy. So, what about higher bond yields? Some folks say a 5 to 6% 10-year Treasury yield could choke off the rally. But Lee isn't worried. Right now, the 10-year is around 4%, manageable for the government, the economy, and companies. At those rates, businesses can still borrow and invest profitably. 4% interest isn't going to break corporate America. Now the big question, recession. Does Tom Lee see one on the horizon? Not necessarily. He acknowledges that parts of the economy are struggling, what he calls rolling recessions. Housing, for example, has been in a slump for 3 years, but the broader economy kept chugging along. Weakness in one area is offset by strength elsewhere. The key is to watch credit markets, specifically the high-yield bond spread. If those spreads blow out, that's a warning sign. But right now, Lee isn't seeing it. Perhaps Lee's boldest stance is how forcefully he dismisses recession forecasts from economists and pundits. In his words, "In my 30 years, I've never seen an economist get the recession right." So the fact that many are claiming there's one coming probably tells me the odds are very low. When the herd is certain a recession is coming, Lee bets against them, and history is on his side. So, what's next? In a word, higher. Tom Lee remains bullish. He thinks the upside isn't finished. As we move past recent scares, the focus will shift to the future, and the future could be brighter than most expect. Lee urges investors to look 6 to 12 months out, into the end of 2025 and 2026, rather than fixate on yesterday's news. He sees potential for positive surprises, a resolution to the trade war, deregulation, maybe even tax cuts or improved trade partnerships. All of these would boost profits and expand market valuations. Bottom line, the building blocks for a stronger 2026 are falling into place. Markets are forward-looking and soon will be pricing in 2026 numbers. If those look positive, stocks could move even higher. Lee's advice? Don't get hung up on current turbulence. Focus on companies that can adapt, cut costs, and innovate through challenges. So when you add it all up, a resilient economy, heaps of cash ready to invest, reasonable interest rates, healthy companies, and the prospect of policy wins, Tom Lee's view is that the bull market still has legs. He's not calling for a straight line up, markets never move that way, but he believes the path of least resistance is higher. You know, every big sell-off in recent years, March 2020, October 2022, April 2025, has actually been a buying opportunity. Investors who keep that in mind will be rewarded. So, what do you think about Tom Lee's latest predictions? Is he right, or is he just a permabull? Will the next 50 years see markets go straight down, or will companies keep finding ways to grow, innovate, and profit? Will governments keep printing money, pumping up asset prices? Let us know your thoughts in the comments below. Thanks for watching, and we'll see you in the next one.